Hi everyone, this is Abdul Chowdhury from Dynamic Tax and Accounting. I want to talk about sale of home today. So there's two types of sale of home. One is your personal residence and another one is for your rental property. For your personal residence, everyone should be aware that there is an exclusion up to $250,000 if you're a single person, and there's an exclusion up to $500,000 if you are married filing jointly. So if you're selling your personal property, if you lived in that house for 2 years out of the last 5 years, you are able to take that exclusion. So if you're talking to your real estate agent or whatnot, and if you're worried about that tax rule, you should at least do some research on that. So now there's a caveat to that, right? If there's some people who has two-family house, who has rental property, has a rental property, and then they lived in one of the apartments in their property. So let's say if it's a two-family house, okay, you have to divide that price, and then where you're going to get the exclusion for the piece, for the prorated percentage of the house that you lived in, of the apartment, and then the other part is going to be the rental side. Okay, so if it's a two-family house, 50% of that is going to be excluded completely, as long as the gain is up to $500,000 if you're married filing jointly. And you have to pay taxes on the gain tax on the rental side. Now, a lot of people will be like, oh my God, there's gonna be a lot of tax. Yes and no. Why? Because it's a long-term, hopefully it's a long-term rental property, okay? Then your gain tax is gonna be, as long as you stay more than a year, your gain tax is gonna be on the lower long-term tax bracket, which is gonna be 15 to 20%, and so on and so forth. You should also ask your real estate agent if you're selling a rental property, okay? You have to ask them about the 1031 exchange. What is 1031 exchange? If you are investing the gain and buying a similar type of property, investing the amount that you got and buying a similar type of property, like kind property, which is another rental property, then you don't have to pay taxes. You just have to report, and then you don't have to pay taxes at all. So ask them about the 1031 exchange, how you can save money on that end. So going back, let's say you sold the property, it was a rental property, you did not have the 1031 exchange. What happens? What happens is you have to account for the cost, how much you purchased it for, how much depreciation you took, and then you can add how much renovation you did. That's where you're going to save the money, okay? So be aware of that. As far as sale of your personal residence, we talked about it. Make sure you report the gain, because there's no downside to that, right? Because you don't have to pay taxes. But if you do not report, they're going to be 1099 issued after 1 year, 2 years, 3 years. You're going to get a matching letter. When you get the matching letter, then it becomes a problem to prove. Then you have to go back and forth with IRS. Is it possible to prove? Yes, but then you have to do amendment and so on and so forth. And it's, as we all know, it's not easy to deal with IRS that easily. Now let's talk about accounting for rental properties in your tax returns. Whenever you have a rental, now they do a geographic audit, especially in New York State, where if you are understating your income, rental income, let's say in the Bronx or in Queens, you're renting the property. You're saying that you're renting the property for $1,000 a month, in an apartment for $1,000 a month. It's not really believable. So in that case, especially New York State is saying this is not reasonable. This is not where the market is. Now they're doing an adjustment, which is actually worse than actually reporting. What you should do, make sure you're taking your depreciation properly. Make sure you're taking your repairs, maintenance, any legal costs. Just make sure that you're taking all this. Everybody is worried about, okay, you know what, let me understate the income. Let me understate the rental income. But what about all your expenses? Are you making sure that all the expenses are there? Now, IRS, New York State, the audit rate is much, much higher than before. So you should be definitely aware of that and then go from there. If you have any questions, please let us know. Thank you.
Dynamic Tax and Accounting. Affordable, experienced, and always available.